In a previous video, I mentioned that I may be thinking of stopping contributions into CPF simply because I realized that Singapore savings bond rates have been climbing fast. Back then, that was in May 2022. And if you look at the charts, that was the first time that the 10-year rate was more than 2.5%, which is the CPF OA rate. In that video, I also saw comments, CPF rates are compounding, but Singapore savings bond rates, they are simple interest. That's true, but that is not the main point, because the main point was that Singapore savings rate were going up quickly, and fast forward today, we realized that Singapore savings bond rates for the 10-year on average is a staggering 3% already. In today's tutorial, I'll be explaining Singapore savings bonds in a few key parts for this whole tutorial. The first is, in a simplistic term, how can you actually purchase? Who is eligible to make a purchase of the Singapore savings bonds? The second part, I'll show you how you can apply it to your own personal finance. The third is I'll share with you my forecast as to how Singapore savings bonds will play out in the next couple of months. So if you're keen, continue watching on. Hi guys, welcome back. Let's firstly describe how to understand the Singapore savings bonds. I have this formula, WAG formula. W stands for withdrawal. In Singapore savings bonds, you have no lock-in period, which means when you purchase it this month in July, you can actually choose to sell it away as early as August next month. Of course, there's a 1 month lag period before the proceeds are paid out to you, but there is no lock-in period. You know, for fixed deposits, you have to keep it in for 6 months, 12 months, or even 18 months. But as Singapore savings bonds, you have absolutely no lock-in period. If you don't withdraw it, you'll simply mature in 10 years' time. That is why Singapore savings bonds, in my opinion, is a fantastic place to park emergency cash. It is just that for the last few years, the rates were so poor, you might as well do something better with it. And you know, if you just look back 1 year ago, short-term bond rates were a much better place to park your emergency cash. But as of now, Singapore savings bonds are definitely a superior option. The second part of the formula is A. A stands for anyone. As long as you have a CDP account, be it whether you're a Singaporean, PR or foreigner, if you have a CDP account, that is where all your transactions and where the bond can actually be held in custody for you. With the CDP account, simply make a purchase via OCBC, DBS or UOB's iBanking or ATM network. G in the formula stands for guaranteed. Singapore savings bonds rates are guaranteed. The principal is also guaranteed. That is great because if you think about it, when you buy a bond on the market, the price can change. But Singapore savings bonds, it does not have a market price, which means you can choose to sell next month. You at least get back your principal as well as the accrued interest. So WAG formula applies. W stands for withdrawal, anytime withdrawal. A stands for anyone. Anyone with a CDP, with DBS, OCBC or UOB's account. G stands for guaranteed. Principal is guaranteed, interest is also guaranteed. So with that, let's move on to the second segment of today's tutorial, which is how you can apply it to your own financial planning, as well as how to actually make the purchase online. So let's start with the second part, and I'll do a quick demonstration for you. I use the OCBC account, and as you can see, simply go to the investments and go to the Singapore Government Securities. Subsequently, you'll come to this page whereby it shows you Singapore savings bonds as well as SGS and T-bills. Simply go for the first option, and everything that you need to know is already mentioned over there. 10 years, $500 minimum, interest payment every 6 months, which means the one that you're buying now in July actually starts on 1st of August. The coupons are going to be paid every February and August. Scroll down and you actually see this button, which is in future if you choose to withdraw or redeem it, click this button. If not, make the buy purchase. What you'll see over here is the opening and closing dates on the left. So do remember there's always a closing date, which is a couple of days before the end of the month. And if I'm not wrong, you cannot make any transactions over Sunday. Minimum and maximum is indicated over there. And speaking to here, you realize that the maximum that anyone can buy is $200,000 in total. But for this bond issue, I don't think it's such a good idea to place $200,000. Give me a while, I'll explain it. But if you want to put an amount which is $20,000, simply input over here and it will let you transact. The results of the purchase will come a few days after the closing date. You know, I mentioned that it's probably not a good idea to ballot $200,000 for this particular tranche. The reason is quite simple. Let's look at what happened in June. You realize that the tranche was 600 million, correct? And then there was 1.3 billion that went to ballot, me included. I actually had a previous older Singapore savings bond, which was 100,000, but the interest rates were way lower. I actually explained in a previous tutorial, which I'll leave towards the end of this also, that it makes a lot of sense for me to sell that, pay that $2 transaction, and buy the newer tranches, which promise a higher immediate return as well as a higher future return of 3% average for 10 years. But what I realized is that when I pumped in 50,000, I only got allocated 18,500 as stipulated at the bottom over there. That is why you see a refund of $31,500. This tranche is going to be only 700 million. And from every indication, I think it's definitely going to be oversubscribed also. So if you were to put 200,000 there, you just forfeit away certain possible day-to-day interest sitting in a bank account. I do think that allocations above 20,000 are very unlikely. That's why I do suggest maybe that amount or slightly lesser to be realistic in getting full allocations. So speaking to here, if you have any questions, leave in comment sections. I'll try to pick them up for you. And as always, if you have benefited, smash the like button. It helps us reach a bigger audience together. And smash or subscribe if you like content like this that helps you in your financial planning as well as understanding investment products. So let's go to the third segment for today, which is my view of what's going to happen for Singapore savings bonds. And this portion is very much my own view. It is not financial advice. But let me explain what I'm seeing on bond markets. From May, when I did that previous tutorial to now, you realize that the 1-year rate has jumped quite significantly, correct? Much more than the average for 10 years. And that's an interesting observation. But moving forward, I do believe that everything that's going to be issued in September, October onwards, the increment may not be as steep as previously. And here's why. Take note of this. This is the 2-year US Treasury rate. You realize that it's actually peaked out somewhere in mid of June, correct? The same can be also seen in the US 10-year Treasury. It peaked out also kind of mid of June. From every indication, it looks like markets are pricing that future inflation or near-term stress from inflation may be subsiding. That's why market is selling off. The other reason could be markets foreseeing recession. So it's really buying more bonds and selling equities. So that is a second possible scenario what institutions are looking at. Fed has indicated that they are still intending to raise rates. I'll actually deep dive a bit more on this in the members channel. So if you're keen, look for that. I've actually a relation between that as well as my belief on bear market rallies that are going to come in the next couple of weeks. So if you're keen for the discussion, check out the members channel and look for the join button. An interesting finding also is that the whole world is raising interest rates, correct? US being the superpower of finance, when they raise, the world raises. Europe including, Singapore including, but there's one place which has not bit the bullet and raise interest rates to combat inflation. That place is Japan. If you look, Japan's rates have been artificially suppressed still. And that has caused Japanese yen to tumble tremendously. If you are curious, how come Japanese yen is so cheap? You are thinking of going there for a holiday end of year. In any case, Japan is still not open yet, but I'm also thinking of Japan. Japanese yen is really cheap, and it's because their central government is still trying to keep the interest rate low. As always, leave your thoughts and comments below. I'll be keen to hear also. And hopefully in this whole discussion, I've explained how Singapore savings bonds actually work. Thank you for watching to here. Invest safe as always. I'll see you in a future video. Check out my previous tutorials. See you there too. Take care and goodbye.